October 24th, 1929, New York City, 9:30 in the morning. The stock market opens as usual. Traders take their positions. Everything looks normal. By 10 a.m., something is wrong. Prices are falling, not gently, falling fast. By noon, panic has spread across the trading floor. Traders are screaming. People are selling everything. Prices are in free fall. By the end of the day, billions of dollars of wealth have simply vanished. Over the next 5 days, known as Black Thursday and Black Tuesday, the US stock market loses a third of its value. And this is just the beginning. Within 3 years, 15 million Americans are out of work. That is 1 in 4 workers. Banks across the country close, taking people's savings with them. Factories shut down, farms fail, families lose their homes. But here is what makes this truly terrifying. The collapse does not stay in America. It spreads to Europe, to Asia, to Latin America, to everywhere that was connected to the global economy. By 1932, the Great Depression has made the entire world poorer, angrier, and more desperate. And that desperation would have consequences that changed the 20th century forever. This is the story of how it happened and why. Welcome to OP Vault. To understand why the crash was so devastating, we need to understand the decade before it. The 1920s in America were extraordinary. World War I was over. America had emerged as the world's leading economic power. Industry was booming. Cars were becoming affordable. Radio was connecting the country. New technologies were changing everyday life. And the stock market was going up continuously, year after year. People who had never thought about stocks were suddenly buying them. Not because they understood business, but because prices kept going up and everyone wanted a piece. Here is the dangerous thing about a rising market. When prices go up, people borrow money to buy more stocks, because why not? Stocks always go up. You borrow today, the price goes up tomorrow, you sell, you repay the loan, and keep the profit. And this is called buying on margin. And in the 1920s, it was completely out of control. People were borrowing 90% of the money to buy stocks, meaning if you wanted to buy $1,000 of stock, you only needed $100. The other $900 was borrowed. This worked beautifully as long as prices kept rising. But what happens when prices fall? Even a small drop can wipe out everything you own and leave you in debt besides. The entire market was built on borrowed money. And borrowed money always has to be repaid. By 1929, the stock market had risen to levels that made no economic sense. Prices had been pushed up by speculation, not by real business performance. Smart investors, the ones who looked at the actual numbers, had been quietly selling, taking their profits, getting out. Then in October 1929, something broke the confidence. It started slowly, a few bad days. When prices fall, people who bought on margin get margin calls and their brokers demand more money immediately. If they cannot pay, their stocks are sold automatically. This creates a cascade. Forced selling drives prices lower. Lower prices trigger more margin calls. More margin calls mean more forced selling. Prices spiral down. On Black Tuesday, October 29th, 1929, 16 million shares were traded. That was an unimaginable number at the time. Prices fell through the floor. People who had been millionaires on Monday were broke by Wednesday. But here is what made it worse. The banking system. When people panicked, they rushed to their banks to withdraw their money. Banks, however, had lent out most of that money. They did not have enough cash to pay everyone. Banks started failing. When one bank failed, it spread fear to the next. Thousands of banks collapsed. People's savings, everything they had worked their entire lives for, simply disappeared. The crash in America was bad enough, but what happened next was worse. America had become the world's bank during the 1920s. American money had flowed out to rebuild Europe after World War I. American banks had loaned enormous sums to Germany, Britain, and France. When American banks collapsed, they recalled those loans. They needed the money back. European countries that depended on American loans suddenly found themselves cut off. Their economies began to collapse too. Germany was hit especially hard. It had been borrowing American money to pay war reparations to France and Britain. When American loans dried up, Germany could not pay its reparations. The German economy collapsed. Economic desperation leads to political extremism. The conditions created by the Great Depression in Germany would help bring Adolf Hitler to power.
Global trade also collapsed. Countries started building massive tariff walls to protect their own industries. This is called protectionism. America passed the Smoot-Hawley Tariff Act, dramatically raising taxes on imported goods. Other countries retaliated with their own tariffs. Suddenly, international trade fell by 65%. Less trade meant less economic activity, less jobs, less income, more desperation. The entire global economy was in a death spiral. Here is one of the most important lessons from the Great Depression. When the crash happened, governments made everything worse. Their instinct was to do what you might do if you personally were short of money. Cut spending, balance the budget, tighten the belt. This sounds responsible. It is actually catastrophic in a depression. Here is why. In a normal economy, when the government spends less, private businesses and people pick up the slack. But in a depression, private businesses and people have no money. They cannot pick up the slack. When the government cuts spending in a depression, there is simply less money in the economy. Less money means less spending. Less spending means less business. Less business means more unemployment. More unemployment means even less spending. The economy contracts further and further and further. And America's Federal Reserve also made a catastrophic mistake. Instead of printing more money to ease the crisis, they raised interest rates. This was exactly the wrong thing to do. It made borrowing more expensive, further strangling businesses and consumers. It took almost a decade and an enormous government spending program, Roosevelt's New Deal, to begin pulling America out. And it was ultimately World War II, with its massive government spending on military production, that finally ended the Great Depression. The lesson that economists took from this experience permanently changed how governments respond to economic crises. Let us zoom out and see the full picture. The Great Depression started with a stock market that had become completely disconnected from reality, built on borrowed money, speculation, and the belief that prices would go up forever. When that belief broke, everything built on top of it broke too. Banks collapsed, businesses failed, trade stopped, governments made things worse, and the misery spread across the entire world. The Great Depression was not just an economic event. It reshaped politics. It brought dictators to power. It led directly to World War II. It changed how governments think about managing economies forever. Before the Great Depression, most economists believed markets were self-correcting. If there was a crash, the market would fix itself. Government should stay out. After the Great Depression, that belief was dead. Governments understood that when markets fail badly enough, someone has to step in. That is why today, when there is a financial crisis, like in 2008, governments and central banks act immediately with stimulus and bailouts. They learned this from 1929. History does not repeat itself exactly, but it rhymes. And knowing the patterns can help us avoid the worst outcomes. If this video gave you a new way to understand economics, hit that like button. Share it with someone who needs to understand why stock markets matter. Subscribe to OPI Vault. Next time, we go even deeper into economic history. Next up, the Silk Road, the ancient trade route that connected the whole world. See you there!